Welcome to this episode of InvestU. Today we'll be doing an analysis of the Alphabet stock, which is traded as tickers GOOG or GOOGL. Let's go into some basics of this stock. Alphabet Incorporation is better known as Google, and they offer a wide variety of service offerings, and they're known to be quite the innovative company. Some examples of their diverse offering are YouTube, obviously we know the Google search engine, Nest, they recently acquired Fitbit, and previously they also acquired the Android platform. So there are two tickers for the Google stock. One is GOOG and the other is GOOGL. And you may be wondering, these trade fairly similarly in value, so what's the difference between these two stocks? So the GOOG stock is a Class C stock, which is to be traded at a slight discount of the GOOGL Class A stock. And really the only difference between these two is the Class A stock, GOOGL, actually gives you voting rights. So if you're interested in that piece of things, then I would highly suggest you get into the Class A stocks. If it's just for investment purposes, you'd be looking for the Class C stock for GOOG. This stock is traded on the NASDAQ. This analysis was performed on the 20th of February 2020. The market cap right now is about 1.04 trillion. The stock price presently is $1,516.99. And the total number of shares outstanding are about 745 million. So that breaks down into the Class A shares for GOOGL of about 298 million. There's a Class B share, which is designated for largely their corporate founders and have extra voting rights. And there's about 45 million shares outstanding. And then there's a Class C stock, which is GOOG as mentioned, and there's 402 million of them. So let's dive into some key metrics. So as mentioned, the price is $1,516.99. It has a PE ratio of 30.86, an earnings per share of 49.16, which translates into about 3% per year, a dividend yield of 0%, which is not surprising given that it is a tech stock, a price to book of 5.18, which provides us with a margin of safety about 20%. Really great debt to equity and debt to assets, 0.07 and 0.05 respectively. The return on equity is quite efficient for management. It's 17.3%. We have a current ratio of 3.7, which is well positioned above 1.5, which is our target that we typically look for as value investors. And it has an EV over EBITDA of 19.62, which is slightly high. The gram number we're not showing for this because a lot of the gram numbers take into account the outstanding shares, and to calculate this for GOOG and GOOGL is a little bit convoluted. The correlation to the S&P 500 is about 0.46, which suggests that half the time it does move in step with the S&P 500. If you're looking for some examples of lower correlation stocks within the S&P 500, I would suggest checking out food and beverage, financial, and energy sector stocks to diversify your portfolio with Google. So let's head into an intrinsic value calculation. So we're utilizing a growth rate of 16.7%, we're discounting it at 10%, and a growth rate in perpetuity of 2%. So using a 2019 free cash flow number, we come up with 1,646.09, which suggests that this stock is undervalued at this point, which is excellent considering the market conditions and where tech stocks are at the moment. So let's dig into some of the trends and figure out how we got here. So looking into the free cash flow, we look at this trend and it really does have a good correlation with a linear model. And we're seeing fairly steady growth over the years. So this is really promising from a value investing standpoint. The enterprise value probably has one of the stronger R-squared correlations with a linear model that I've ever seen. And that suggests great growth over the years. The revenue trend also adheres to a linear curve, and one could suggest it may be exponential, but we see very strong growth year over year for Alphabet. Net income generally adheres to the linear trend as well, and we see strong growth year over year. So let's dig into the annual reports and find out some positive and risk with this company. So some positives, we see consistent growth in revenue across multiple streams year over year. This is one of the things that I'm really impressed with Google. So if you look at all their service offerings, whether it's ads, YouTube, their hardware, they're seeing steady revenue growth year over year, which is really unparalleled. There almost isn't an area of this company that is not seeing strong revenue growth at the moment. The company's touted for their innovative processes, and they using moonshots, which is making massive changes rather than small incremental changes. And I think we see this in the diverse product offerings for things like Google Docs. They acquire companies like YouTube and Fitbit and Android, for example. They're very well positioned for strong growth for the future. So a couple examples of this are Chromebooks, the G Suite, YouTube, and Google. And I'll focus in on the G Suite and Chromebook side of things, which I think really positions themselves well for the future. So one of the things that my kids utilize at school is Chromebooks when they're doing any research for projects or any work in the classroom. They use the series of G Suite documents, which will give them the familiarity with these products. And I would highly suggest that this is something that will be positioning Google or Alphabet for growth for the future as they're getting younger generations accustomed to their products. As mentioned, they have a strong history of acquiring other companies that are performing quite well. So Fitbit and YouTube and Android are examples of that. And their focus on machine learning and AI development is really helping drive revenue growth and innovation. So looking at their various sectors, we see in each sector there is strong growth year over year from 2017 to 2019. You'll see that primarily they obtain revenue through their ads and their search engine, which drives the majority of their revenue. But the main takeaway of this chart is just to highlight the fact that there is strong growth in each area year over year. So some negatives for Alphabet is they are really positioned for potential for lawsuits across a broad range of deliveries. As people become more in tuned into how their data is being utilized online and potentially sold, I think that there is some concerns in this area, as well as competition laws in the EU. So they've had a number of lawsuits for Android and AdSense over the past few years that have resulted in settlements upwards in the billions. So this can impact their revenue on a yearly basis. The other thing to keep in mind is they're in a very competitive environment. There's other search engines, there's vertical search engines and e-commerce sites, which may take away from people Googling certain products. There's social networks like Facebook and Snapchat that people utilize for product referral for these networks versus traditional searches. And there's other forms of advertising which can compete against them, like billboard magazines, TV, and online. So getting back to the intrinsic value calculation, as mentioned, we're going to utilize a growth of 16.7%. Based on the net income trends that we're seeing, which again adhere to a good linear model. It's discounted at 10%, and we'll use a growth rate in perpetuity of 2%. So using the 2019 free cash flow, we get, again, a 1,646.09 intrinsic value, which suggests that this tech stock is presently underpriced. And the book value per share is $292.65, which gives us a margin of safety of around 20%. So all in all, I recommend Alphabet to have in your portfolio. It is a rare tech stock that is undervalued at this point in time. They're well positioned for growth. And if you look back to the 2008 stock market crash, Google had consistently strong revenue growth through the periods of 2008 and 2009. And that has led into almost exponential revenue growth since then. So I think this is well positioned to help protect against recessions. And though we may see minor dips in value, which we may want to keep our eye on, this is a tech stock that should hold its value over time. Thanks again for tuning into this episode of Invest You. Don't forget to click subscribe below, and we hope you tune in to our analysis next week.